The S&P 500 is up 9% this year, now trading at just about 14 times earnings, still relatively low versus historic standards. But are stocks cheap? Our next guest says no. Tobias Levkovich is the chief equity strategist for Citigroup. He joins me here in the Bloomberg newsroom. Tobias, always glad to have you in. Thanks for coming. So you say you don't necessarily have a quarrel with valuation. You say it's just not reason enough to either buy or sell stocks. What do you mean by that?
Well, one can buy cheap stocks that unfortunately can become cheaper. You can buy expensive stocks that become more expensive. Momentum tends to be far more important than valuation. On some of our metrics, valuations look pretty good. On some of them, they don't look as good. So it's kind of a more mixed bag there.
Would you work backwards, though? Can you define whether or not you think stocks are cheap right now?
I think if you looked at the valuation just simply, and we use trailing earnings rather than the forecast, because clearly forecasts can be wrong. If we use trailing earnings, we look at bond yields, we look at risk premiums, we're basically about 17% undervalued. So that would argue, yeah, that's pretty good news. Unfortunately, when we look at the price to book of the market against, for example, government involvement as a percent of GDP, you're overvalued. So they kind of negate each other. So
basically, you're saying it's not impossible that stocks go up a little bit from here, but it seems like, according to your research, you think that mid-year becomes a trouble spot.
I think mid-year we're looking at an environment where we kind of have the coalescence of 5 or 6 items that on their own are probably not that meaningful, but combined they are, almost like we saw back in January, the combination of the rhetoric against the banking industry, China monetary policy issues, Greece. Those three combined in about a week and a half's time started to weigh on the market. And just to give you an idea of what's in there, Fed removing extended period language, midterm election uncertainty, focus shifting to 2011 when we don't know what's going to happen with the tax code, factors that involve a variety of issues, potentially more China trade friction.
So how much do you think the S&P 500 is going to lose if you had to call it? I know it's hard to be precise.
Well, we think the market could trade up to 1250 along these very powerful earnings. Our target for the year was 1175, but we could see a 10% type correction in mid-year.
Because a lot of people are pointing to earnings. Something like 80% of the S&P 500 companies that have reported so far have exceeded expectations. So you can argue perhaps expectations were so low that it was easy to do, but it does seem like there has been some earnings momentum. But you say, look, that's nothing compared to these headwinds that we're going to see mid-year.
Well, we thought earnings would be very strong. We looked at the cost cutting. We looked at some of our lead indicators on margins. Credit conditions were very, very supportive for a rebound. And in fact, one of the big differences is back in January, we surveyed our clients, and 52% of them told us they thought street estimates were too high. And we surveyed them a couple weeks ago, and they were telling us on the other now over 60% think estimates are fine. So you've seen a real change or a sea change in investor sentiment as well, from being very, very nervous to becoming a little bit too excited.
Another subject that many people are weighing in on is the strength of the U.S. economy. And I mean, even the Fed is meeting this week. Obviously, that's going to be part of the discussion. How should this, your opinion about this, factor into what you do with your money in the stock market?
Well, I think the economy is going to look pretty good. As I said before, credit conditions lead, and they lead industrial activity, they lead job trends, things like that by about 9 months. So we're pretty convinced that we have the makings of a sustainable, durable recovery. The question is, what's getting priced into the market? And a lot of this good news is already starting to get priced. The fact that people are now kind of converting and going from becoming skeptics to believers is more of an indication that markets have kind of borne them out to be wrong, rather than, wow, this thing's going to keep rallying forever.
Tobias, before you leave us, just give us maybe 1 or 2 picks that you think are worthy of attention, even if they're group picks, sector picks.
Sure. A couple of areas. Capital goods. We've seen a couple of the major industrial companies already report showing really great leverage here. I don't think that's over with. As their production rises, their overhead absorption variances, nice accounting gobbledygook, really generate some powerful earnings. I don't think investors have fully bought into that.
So these are groups that maybe will even sustain this mid-year cloudy period.
I think so. The other areas that we look at, and we just upgraded, for example, the insurance industry group. We think the valuations there are pretty compelling. Some of our lead indicators suggest that they should continue to do well in a potentially tougher environment.
All right, Tobias, thank you so much. Tobias Levkovich joining us there from Citigroup.